and gentlemen, welcome back to the channel. Welcome back to an exciting day in markets. Now, I will tell you, today's jobs report was not good. But considering these September seasonals are so bad, I'm actually impressed with how well the markets are doing today. For an example, the Russell, IWM is the ETF or ticker. It's up 1/3 today. You're actually in the green. With the kind of jobs report we got today, it's kind of impressive. NASDAQ is down 0.1%, not doing too much. S&P is down closer to a 0.5%. Maybe it's interesting that even yesterday I talked about the Russell that looked like it wanted to break out. Nonetheless, neither here or there, we're going to go over all of your breaking news today for markets. What could be coming next for stocks? Hit that like button and subscribe to the channel if you have not done so already. And let's get into today's episode. First things first, let's get into the raw numbers here. So non-farm payrolls for last month came in at 73,000. You got revised up to 79,000. Okay, now the numbers for June were 14,000 positive. They were revised negative to negative 13,000. So the June revision is pretty rough, technically negative, but last month's revision was actually slightly positive. Now the expectation for the jobs number today was 75,000. We came in at 22,000. Yeah. That's not great. Okay, not great at all. Unemployment rate was expected to rise from 4.2% to 4.3%. We did rise to 4.3%. Okay, so unemployment rate came in line with expectations, but the headline jobs number came in pretty bad. Now, good news, participation rate did go up a little bit to 62.3 when previously it was 62.2 and expected to be 62.1. Average hourly earnings month over month came in line with expectations at 0.3%. Average hourly earnings year over year came in at 3.7% in line with expectations. So that was the big catalyst today. That's really what everyone has been preparing for this whole week was the jobs report. And again, honestly, I'm impressed that the Russell's green today. The NASDAQ basically unchanged, down 0.15%, but not much at all. S&P's down 0.5%. That's more of an expected reaction. But honestly, I'm impressed. Because why? As I've talked about on this channel many times now, I sound like I'm beating a dead horse here. But just for the sake of this video, I will do it again for anyone that has not heard this. What do you think? Like, do you think rate cuts are bullish or bearish? Just ask, just like generally, are they bullish or bearish? What if I told you rate cuts are neither bullish or bearish for stocks? Neither good or bad. The reason why the Fed is cutting rates is bullish or bearish. Rate cuts in and of themselves are not. Okay, here's the deal, and here's why that is. If the Fed is cutting rates because inflation's falling, because the economy is doing okay, and they want to prevent further weakness in the economy, that can be seen as a positive. In that scenario, rate cuts could be a positive for stocks. In the adverse scenario, that the economy starts to tank, labor markets start to tank, a crisis is brewing, rate cuts are not good. Okay? So not just the Fed cutting rates, but it's the reason why the Fed is cutting rates. Now, obviously, after a jobs report like today, the odds of Fed cuts are skyrocketing. Okay? You now have a 10.3% chance of a 50 basis point rate cut September 17th. An 89.7% chance or 92.1% chance of one rate cut. So yeah, that's a bit of a change. Okay, for October 29th, there is a 78.8% chance of another cut. So almost a certainty that you get a cut in September and a cut in October. For December 10th, almost a certainty that you get another cut at 70.1%. And these odds really skyrocketed today. The odds of the third cut December 10th yesterday were 46.4%. Today, 70.1%. So this jobs report today really boosted the odds of rate cuts. What I'm so impressed with, and what I think is important to understand, is even though we got a bad jobs report today, Wall Street is not panicking. It seems like to me, via the Russell, being kind of green today, at least was green, partially green, Wall Street is saying Fed cuts could help stabilize and support the markets. Basically, that the Fed is not late, that we don't have some kind of huge economic problem, even though we got a bad jobs report. It's not like we're hurtling into a recession. That's at least what the markets seem like they are implying today. With these revisions over the last 2 months, employment in June and July combined is 21,000 jobs lower than previously reported. And you can see today 10-year Treasury yields are down 10 basis points to 4.076%. You can see here, breaking news, mortgage rates see the biggest one-day drop in over a year. The average rate on the 30-year fixed mortgage dropped 16 basis points to 6.29% on Friday. This is a major change from May, when the rate on the 30-year fixed peaked at 7.08%. So yeah, this is good for getting the consumer some relief on the rate side. Now, Goldman Sachs says by the September dip, Goldman Sachs macro trader Paolo Schiavone advises buying September's stock dip, predicting the S&P 500 could climb to 6,700 to 6,900 as rate cuts boost growth. A note issued before the latest jobs report, he said markets are already pricing in a Fed cutting cycle that will spur economic reacceleration. August jobs growth was just 22,000 versus 75,000 expected, with unemployment at 4.3%. The weak data pushed the dollar lower, yields down, and stocks higher. Schiavone sees the Fed's long-run rate near 3%, similar to the ECB, and expects stretched valuations in credit and equities to persist. He recommends owning rates volatility, buying equity dips, and watching NASDAQ and Russell indexes for signals. So, in big news today, Saudi Arabia wants OPEC Plus to speed up the next oil production boost. Why this is good is because more supply means lower prices. And lower prices, for like the economy, is massive. Oil, it single-handedly is the biggest single driver to economic activity. If gas goes up $1 a barrel, that's a huge drag on the consumer, by and large, because everyone uses it. Okay, if gas goes down $1 a gallon, that's a big boost, and more production means gas prices should fall. On the Bureau of Labor Statistics numbers today, he says real numbers will be in a year from now. White House senior advisor Hassett on the U.S. economy says we have to look at the whole portfolio of numbers. He says on the jobs data, it was a bit of a disappointment. He says that he expects the U.S. job numbers will revise up. And he says the jobs number is likely to be revised up by almost 70,000 jobs. Hassett says that the economy is prepared for tariffs. And he says the housing sector is still a disappointment. He also says that investments in the U.S. will drive incomes higher. And Hassett on the Fed says there's a lot of reasons for optimism. And Hassett on wages says they could offset inflation. He also says an independent Fed is really important. U.S. Senate Democratic leader Schumer says Democrats will force votes in coming weeks to reverse Trump's import tariffs, citing Friday's jobs report as a reason. White House senior advisor Hassett says that the deficit scenario is looking optimistic. He also says that Trump knows we're optimistic about future of jobs numbers. Hassett on the jobs data says inflation is low and economic growth is solid. He also says that we need to do a better job of adjusting data. Revisions have been huge. And Hassett on the Fed says that he expects they will discuss a larger cut. He says there is a connection with jobs and immigration enforcement actions. He says that he is confident that native-born workers are replacing illegal workers. Bank of America now sees 2 2025 rate cuts versus none previously. U.S. Labor Secretary Chavez Duramer says it is past the time for the Fed to act. He calls on the Fed to lower interest rates. And the unemployment rate is now 4.3%, the highest since 2021. Trump says that Powell should have lowered rates long ago. Canada's Prime Minister Carney unveils a relief package for tariff-hit sectors. The U.S. is getting ready to start a renegotiation of its largest free trade deal, the U.S.-Mexico-Canada Agreement, per the Wall Street Journal. 15 counterparties take $20.997 billion at the Fed reverse repo operation. This is something that has got a lot more attention recently as the numbers have really started to dwindle. What this means is there's a lot less excess reserves in the banking system right now. And as these reserves stay at these low levels and presumably go even lower into the future, then it's going to mean the Fed, it's not going to be able to do as much, let's say, quantitative tightening. They're not going to be able to reduce their balance sheet as much. They may have to slow down or even buy assets if these numbers go too low, which historically the Fed buying assets leads to prices in all assets going higher, like stocks. And in an unconfirmed report, Trump is reportedly considering blocking U.S. tech companies from outsourcing jobs to India. I mean, there's a lot of that happens. Treasury Secretary Bessent says the Fed must scale back the distortions it causes in the economy. He says the Fed forecast relied on flawed models, and he says that the Fed must change course. Bessent says when the Trump administration shifted towards tax cuts and deregulation, the Fed's forecasts were too pessimistic. And Bessent says the central bank must recommit to maintaining the confidence of the American people. The CNN Fear and Greed Index today is sitting at 52, which is almost exactly neutral. So, stocks are no longer like overextended from at least a sentiment perspective. There's a lot of bears out there or people that are not nearly as bullish as they were before. Market momentum is neutral. Stock price strength, extreme greed. Stock price breadth is greed. Put and call options in greed. Market volatility is neutral. Safe haven demand is fear. And junk bond demand currently in fear. The most recent AI investor sentiment survey also highlights this, with bullish investors at 32.7%, down about 2% from last week. Neutral investors down about 2% from last week as well, going from 26% to 23.9%, and bearish investors up about 4% from last week, going from 39.4% to 43.4%. So bears are the dominant force out there, and that means there's upside for stocks. What's also interesting today, if you look at the percent of stocks trading above their 50-day moving average, even though indexes are trading lower today, you're actually slightly green. So internally in markets, it's actually not like a terrible day. Not like you'd expect if you looked at the headline S&P that was down about 0.5% today. Now, if you look at some big tech names, Palantir down 2%, Microsoft down about 2.5%, Nvidia is down 3%, Amazon down 1%. Most of the heavy, lifting, if you will, to the downside today in the S&P is big tech, which honestly, it's a good thing to see. People are selling big tech. They're going into more of your small cap names, your unloved areas of the markets, which I think is healthy. But again, I just want to highlight in September, such a weak seasonal month, the fact that you're seeing anything positive out of markets today is pretty impressive. And honestly, like, I think these are probably the worst of the jobs reports, right? Because I think the data is lagged behind a lot. So I think some of the numbers we're getting from the jobs reports today are really like June, July kind of numbers, right? I don't think the August jobs report is really August. I think when you look out in the economy, it's better than just 22,000 jobs being added, right? Like, it's not hot, it's not super great out there, but it's not like recessionary. It's pretty status quo, if you will. There's not much changing. And from that perspective, I mean, we have a lot of bears out there. People are very cautious right now. People are just not excited about stocks. And I think towards the end of this year, once we get through September, really midpoint October through November, December, and into 2026, it's going to become obvious inflation is coming down. Inflation is not going to be the issue that a lot of people thought it was going to be. That some of the deregulation, some of the tax cuts, and provisions in the big beautiful bill hopefully can help the consumer actually do better and recover a bit. Okay. And then you have a focus on AI. You're going to have rate cuts for the right reason. Again, rate cuts for the wrong reason is the economy is heading into a recession, right? Rate cuts for the right reason is trying to prevent a recession, that the economy is doing okay, but we just want to cut rates to get ahead of any further weakness, right? There's a big difference, right? And I think we're going to have a very positive setup into the end of this year. I actually think October, November, December could be some of the strongest 3 months we've seen in a very long time. Okay? Because of all of these reasons put together. And I think, to be honest, 2026 is going to be one of those years you're going to remember for a long time. It's going to be very optimistic. Maybe euphoric. So let me know your thoughts on all of this down below in the comment section. Hit that like button as well as subscribe to the channel if you have not done so already. Have a great rest of your day. Check out that link down below in the description of this video if you want to come join the trading community. We are outperforming 99.9% of hedge funds and institutions. Yes, the portfolio is pretty damn volatile because of the strategy that we target. We are going out, finding small cap AI stocks and investing in those before Wall Street really even knows they exist, right? So we're early, we're getting into these stocks. Wall Street gets into those stocks next, and then retail investors get in once the stocks explode and ultimately drive them to the promised land, if you will, right? So we're getting in early. We like to be early. Portfolio is up 95% year to date, but that does not guarantee future returns. That does not mean you should do reckless shit. Come to your own conclusions. Contact a financial advisor before making an investment decision. But check out that link down below in the description of today's episode if you want to come join. That is it. Have a great rest of your day, and I will see you in the next one.